viewers. Today we're going to tackle some of the most pervasive mortgage myths that are often cloud people's understanding of the critical aspects of personal finance. So let's just jump right in. Myth number 1. Renting is always cheaper than owning a home. This is a widely held belief, but the truth is, this is not always the case. While renting may seem cheaper in the short term, over time, mortgage payments can become an investment in building equity and owning your own appreciating asset. Let's break it down with a simple little example. Say you're paying $1,200 a month in rent, and you'll find a mortgage for a similar property with a monthly payment of $1,500. At first glance, it seems like renting is a cheaper option, but when you consider the tax benefits, potential appreciation, and building equity, owning a home can be a more financially sound decision. Myth number 2. A 20% down payment is required to buy a home. This misconception stops many potential home buyers from pursuing their dream of home ownership. While a 20% down payment can help you avoid private mortgage insurance, it is not the only option. There are various loan programs available that require a low down payment. For instance, you could explore FHA loans, which only require a down payment as low as 3.5% of purchase price. It's important to work with a reputable lender who can guide you through the different options and find the best fit for your financial situation. Myth number 3. Refinancing is always the best option when interest rates drop. While it is true that refinancing can be a smart move when interest rates are significantly lower, it's not always the best choice for everyone. Before jumping into refinancing, it's crucial to evaluate the associated costs and the length of time you plan to stay in your home. If you don't plan to stay long enough to recoup the closing costs, it may be not the most financial advantage. It's essential to weigh out the potential savings against the cost to determine if refinancing is the right decision for you. Myth number 4. A mortgage will ruin your credit score. This is a fear that often holds people back from applying for a mortgage. While taking on a mortgage is a significant financial responsibility, it doesn't automatically mean that your credit score will suffer. In fact, a mortgage can have a positive impact on your credit score if you manage it responsibly. Making your mortgage payments on time and a full demonstration of your ability to handle credit responsibly, which can improve your creditworthiness in the long run. Of course, it's important to stay on top of all your financial obligations to maintain a healthy credit profile. Myth number 5. You should always choose the lowest interest rate. While a low interest rate is indeed appealing, it is not the only factor to consider when selecting a mortgage. When comparing mortgage offers, it's crucial to consider the loan term, closing costs, and the overall stability of your financial institution. Sometimes a slightly higher interest rate can come with a lower fee and more flexible terms, making it a better option for your specific needs. It's essential to evaluate the full. Myth number 6. Mortgages are only for people with perfect credit. While having a good credit score can help secure more favorable mortgage terms, there are loan programs available for individuals with less than perfect credit scores. It's essential to explore different loan options and to work with a reputable lender who can guide you towards the best mortgage solution based on your credit profile. Myth number 7. You must stay in the same job to get a mortgage. While a stable employment history can be beneficial when applying for a mortgage, changing jobs doesn't automatically disqualify you. Lenders consider various factors, including your overall financial stability and ability to make mortgage payments. If you have a new job but a strong financial profile, you can still qualify for a mortgage. Myth number 8. You should always pay off your mortgage early. While paying off your mortgage early can bring peace of mind, it is not always the best financial decision. Mortgage interest rates are often lower than the potential investor's returns, so many more advantages to invest the extra funds rather than pay off the mortgage. Consider your overall financial goals before making a decision. Myth number 9. You can't qualify for a mortgage with a student loan debt. Having student loan debt doesn't automatically disqualify you from getting a mortgage. Lenders consider various factors, including your debt-to-income ratio. Overall, creditworthiness and the ability to make a mortgage payment. It's important to manage your student loan debt responsibly and maintain a healthy credit profile to enhance your chances of mortgage approval. Myth number 10. Mortgage pre-approval guarantees loan approval. While mortgage pre-approval is a crucial step in the home buying process, it doesn't guarantee a final loan approval. Pre-approval provides an estimate of the mortgage amount you may qualify for based on your initial evaluation. The final loan approval debts is dependent through the underwriting process, including verifying financial documents and property appraisal. Myth number 11. You must have a perfect home to qualify for a mortgage. While income is a crucial factor in determining your mortgage eligibility, having a low-income job doesn't automatically disqualify you. Lenders assess the overall financial situation, including your debt-to-income ratio, credit score, and savings. If you have demonstrated your ability to make mortgage payments based on your income and managing your debt responsibility, you may still qualify for a mortgage. Myth number 14. You can't get a mortgage if you're self-employed. While being self-employed introduces additional complexities in the mortgage process, it doesn't mean that you can't get a mortgage. Lenders typically require self-employed individuals to provide additional documentation, such as tax returns and profit and loss statements, to verify their income stability. Working with a mortgage professional experienced in self-employment borrowers can help you negotiate the process smoothly. Myth number 15. Once you're pre-approved, you're guaranteed to get the loan amount. Pre-approval is an essential step in the home buying process, but it is not a guarantee for a final loan approval. Pre-approval is based on the form information provided at the time of the application. During the underwriting process, lenders conduct a more detailed assessment, including verifying your financial information, employment, and the property appraisal before issuing a final loan approval. Myth number 16. You should always choose a shorter mortgage term to save money. While shorter mortgage terms can save you money on interest payments, they are also a higher monthly payment. Choosing a shorter term depends on your financial situation and goals. If you can comfortably afford a higher payment and want to pay off your mortgage sooner, a shorter term may be suitable. However, if you prefer lower monthly payments for more financial stability, a long term may be a better option. Myth 17. You can get a mortgage with a high debt-to-income ratio. While a high debt-to-income ratio can affect your mortgage eligibility, it doesn't automatically disqualify you. Lenders have different debt-to-income ratios required, and some loan programs allow high or higher ratios than others. Additionally, factors such as high credit scores, a stable income history, and a large down payment can offset a higher debt-to-income ratio and increase your chances of a mortgage approval.